don't we get started? We're fortunate to be joined by a guest who I know has a busy schedule, but let me just set the table for the discussion this afternoon. Again, I know it's a lovely day here in northern New Jersey and throughout parts of the country. So thank you for giving us an hour or so of your time. We're going to spend a good portion of the discussion on important legislative updates that may or may not occur in the coming year. But again, I'll let Maddie tee up our guest speaker in a minute. We'll also spend a couple minutes towards the end of the discussion just talking a little bit the state of the state with the market. Obviously, August had some angst early on. We've got a Jackson Hole meeting tomorrow. We wish we were all taking this call or meeting from there. But without further ado, Maddie, why don't you go ahead and introduce our guest Allison today, and we'll dive right into the content.
Yes, we are so excited to have Allison Gilbert, who is also a certified financial planner, joining us from Vanguard. She is a financial planning and coaching specialist over there, and she's responsible for expanding and enhancing the financial planning solutions designed to support Vanguard's financial advisor partners like Tom, Jeff, and I. And she serves as an ambassador to advisors like ourselves by writing and presenting content like what we are about to hear. And she works with end-to-end clients like you all on a wide range of different financial planning topics. She joined Vanguard in 2018 and working as a senior financial advisor within the Vanguard wealth management space. And she had the opportunity to within that role, empower and assist clients, families, and entities, as they plan for, work toward, and reach their financial goals. And prior to joining Vanguard, Allison worked as a financial advisor with E-Trade and Fidelity, something we're all familiar with. She earned her BS in business administration with an emphasis in finance from University of Colorado Boulder, go Buffs. And she, of course, holds her FINRA Series 7 and 66 licenses. Allison, thank you so much for being with us today.
Thank you so much. And I will echo, of course, a big go Buffs also. I'm going to go ahead and start sharing my screen and we can jump into things for today. But really looking forward to the opportunity to getting to spend some time with all of you to discuss something that's top of mind for all of us. We are in an election year, so we are hearing a lot about legislative updates that may be coming to us in the future. So what I'm hoping to do with our time today is really give you those resources. So when you hear those conversations, when you hear those news articles or see those news articles or those discussions happening, you're really informed on what's on the table right now, what could be coming to us, what's already come to us, and how does that impact your financial situation, both now and in the future. In terms of what we're going to cover specifically today, we're going to spend some time first by going through an overview or a refresher, if you will, on the tax sunsetting of the Tax Cuts and Jobs Act, as well as the Secure Act, which has been through several revisions, several updates, and some very, very recent updates. So we want to make sure you're aware of as well. We'll talk a little bit about associated estate and gifting strategies or opportunities that may fit within the context of the changes that may be coming to us. And we'll wrap up with some final considerations we want to make sure that you have and you leave this conversation with. Now, when we think about the overview of the Tax Sunset and Secure Act, these are two pieces of major legislation that will have a material impact on many people's financial futures, as well as their financial presence. So what we want to make sure is that you have an understanding of where do we stand right now and what's on the table that could be changed in the future. So we're going to start on the tax sunset and spend a little bit of time there. Just as a refresher, in 2017, the Tax Cuts and Jobs Act was passed. That was passed in the original Trump administration. And that administration was able to pass legislation that permanently lowered corporate taxes, but it only made temporary adjustments to individual tax provisions. So what we're looking at now is these tax laws are set to expire at the end of 2025. So if we say no additional legislation, no additional intervention, starting January 1st of 2026, everything will revert back to pre-Tax Cuts and Jobs Act stage for individuals. Now, one big caveat on this. we don't know what exactly will happen over the next year and change. We don't know how our presidential election will play out. We don't know the willingness to potentially extend this legislation, adjust this legislation, or allow this legislation to sunset. So we really want to continue to make our planning decisions based off of what's fundamentally appropriate for you and your goals. And that's where, of course, your advisor partners are already doing that great work to really deeply understand, what are your goals? What are your needs? But we still want to understand what's going on and how some of those changes could potentially impact you or open the door for additional planning that you may not have considered yet. So in terms of big changes that would come out of the sunsetting, we have a couple different categories. The first one we want to think of is our tax rate modifications. For most people, if we see the sunsetting of the Tax Cuts and Jobs Act, they will encounter higher income taxes than they currently face. We would see an increase in federal income tax rates. So that's a huge opportunity right there. We talk a lot about, what do we think our taxes will be in the future in comparison to what we know they are right now? All we can plan around is what we know now. But if we have, an informed basis that these may change, we certainly know if this sunsets, that for most people, those rates will increase. Another big category here is going to be the second bullet point, which is deductions and individual tax provisions. Now, this one's kind of a catch-all. There's a lot that falls into this category because there's a lot of smaller adjustments that fall into the same bucket, but I'm going to hit on a couple big ones. Now, when you think about deductions, one big one is if you're making cash contributions to charities currently, you can make a deduction at 60% of AGI. This will sunset back to 50%. So it'll be a reduced deduction amount. On the other hand, if we look at the folks who are itemizing right now, the SALT cap, which stands for state and local tax cap, that deduction set right now at $10,000, that would sunset as well. So that would actually, see a phase out in the other direction. Now, other big ones we think we would probably see, or we know we would see if this sunsets. We start to see things like miscellaneous deductions might come back. Things like, being able to deduct for investment expenses or advisor fees, potentially. We also know that if this sunsets the standard deduction, so if we go away from our folks who are itemizing and go over to our standard deduction claimers, that would be cut in half. So that's going to be a big impact as well and may open the door for more people to consider itemizing at that point in time. We also know things like alternative minimum tax would revert back, which means that many more people would be potentially subject to AMT compared to where they stand now. In 2017, there was a much lower exemption on AMT and income phase out amount. So more people were subject to AMT pre-Tax Cuts and Jobs Act. So we would likely see that as well. And then the last one and the big one is going to be qualified business interest. So the way that qualified business interest works, it was created under the Tax Cuts and Jobs Act, and it's a 20% deduction for pass-through businesses, depending on, their circumstances, their structure. This would go away. So if you own a business, this is a really great opportunity to engage with a tax professional to ensure that your business is established in a way from a corporate ownership standpoint to protect you from this potential impact. And the last and the probably biggest part of the sunsetting is the rollback of the estate and gift tax exemption. Currently in 2024, our estate and gift exemption amount is set at 13.61 for individuals, 6.161 million, and double that for couples. If we see the retirement of the Tax Cuts and Jobs Act, that will cut in half to about 6.8 million. So that's a big impact. If you have a large asset base, it can really materially impact the amount of your estate that would potentially be taxable, which opens the door for a lot of big planning opportunities around what are your long-term legacy and estate goals, and what can we be doing now to protect you from those increased estate increased estate inclusions. Now, again, we don't know what the future holds for the sunset, but we're still going to spend some time looking at strategies that you can potentially use to prepare yourself in the case that it does sunset. Like I mentioned at the top of our conversation, though, we want those strategies really to be in alignment with your fundamental goals, needs, and objectives for your portfolio. We don't want to drastically shift your goals just to chase something that may or may not happen. The other big one I want to talk about is the Secure Act. So Secure Act 1.0 was a major piece of legislation that completely changed how retirement accounts are inherited. And I'm going to spend a little time on this because it's complicated and we've gotten a lot of questions from clients on this recently. So what happened is post Secure Act, which is 2020 or beyond, we've seen the rules for how retirement accounts are inherited change. And it really broke beneficiaries up into 3 categories. We have eligible designated beneficiaries, we have non-eligible designated beneficiaries, and we have non-designated beneficiaries. I'm going to spend a little bit of time on each of them just so you understand what category your own beneficiaries may fall into and what they may be looking at from an inheritance perspective. Pre-Secure Act, we saw stretch provisions in place, which means that when a retirement account was inherited, for the most part, the inheritor was able to stretch distributions over the rest of their lifetime. Now that's changed. So again, I'm going to go back to our 3 categories, and I'm going to start us off with eligible designated beneficiaries. So if you have someone listed who would be considered an eligible designated beneficiary, they get to maintain those stretch provisions. People who fall into that category: surviving spouses, minor children until they reach the age of majority, which has now been clarified to be 21 universally. It's not subject to state rules. We have individuals who are less than 10 years younger than the original account owner. And we have chronically ill or disabled individuals, as well as beneficiaries of what we call a pass-through trust or a see-through trust, which basically just means that we can see through the trust to know that one of those people that I already mentioned is the intended beneficiary. So anyone who falls into that category, they get to maintain those stretch provisions. Spouses get a couple of additional options. They can assume the retirement assets into their own retirement account, which means it just goes from their spouse's account directly into theirs, and it's just treated as their own. They can also, which is a new clarification to the rules, wait until the other owner, their spouse, would have turned required minimum distribution age to begin distributions. So again, if you have a beneficiary in that category, great opportunity to work with your advisor just to really understand how that's going to be treated. But high level, eligible designated beneficiaries, we get to continue to stretch those distributions. That takes us to our non-eligible designated beneficiaries. Biggest category here is your adult children. So if you're someone, you've listed your adult child as the beneficiary on your retirement account, they're likely going to fall into this bucket because they're more than 10 years younger than you. That's the most common. Of course, there's other situations that fall in here, but that's the most common one we see. For these non-eligible designated beneficiaries, that's where this 10-year rule comes into play that the Secure Act 1.0 started. So when we think about this, if you had started required minimum distributions already, you have 10 years, your beneficiary has 10 years to get those assets out, and they need to continue the required minimum distributions that you had already started during years 1 through 9. And that was the clarification that we actually just got in July of this year, is that not only do they have to come out within 10 years, we also have to continue those required minimum distributions if you, the original owner, had started them. Now I'm getting a ton of questions from clients. Hey, I inherited an account in 2021, haven't taken those required minimum distributions for the first 3 years. Am I going to get a major penalty from the IRS? The answer is no. They're waiving penalties up until 2025. So as long as we get them taken starting next year, you'll be just fine. Let's say required minimum distributions hadn't started, you just get that 10-year rule. You got to get it out within 10 years, whether it's year 1, year 10, or something in the middle, just has to be out by 10 years. And the last category is our non-designated beneficiaries. Think your trusts, your estates, your charities that might be left as beneficiaries. If the original owner had started RMDs or required minimum distributions, assets will be stretched over the continued life expectancy of that original owner. If they had not started, you have a 5-year window to get those assets out, but you don't have to continue any kind of distributions. Again, super nuanced system. Want to give you at least the baseline foundation, but if you're in one of these situations where you say, I have no idea what my beneficiary would be considered, work with your advisors. They'll certainly be able to help you navigate this very complex world. Secure Act 2.0 clarified a lot of Secure Act 1.0. It also built in some of the regulations that I just mentioned here. It increased our required minimum distribution age up to 73. We also know that it'll increase again to 75 starting in 2033. We got some new options for surviving spouse beneficiaries, which I mentioned. A huge one here is we got the ability to start rolling over part of unused 529s into Roth IRAs for the same beneficiary. Huge planning opportunity here. A lot of different regulations that go along with that, but a really exciting planning opportunity for 529s and flexibility with 529s if you don't end up needing all those dollars for education savings. And also opens the door for some really careful consideration of how catch-up contributions will be used in the future. Basically looking at high earners and how catch-up contributions will be structured in the future. So again, big opportunities to work with your financial advisor on that topic as well. Now, next thing we want to touch on here is how our individual income tax rates may be increased in the future. So when we think about this, big opportunities here to not only understand this, but also start to implement planning strategies really should be appropriate whether we see the increase or we don't. We start to think about, well, what if we're in a higher income tax environment? What are ways to help mitigate this? What are opportunities for us to start to take some of that tax burden down? We want to think about using things like tax efficient investments, something like an ETF, for example, in our taxable accounts. We want to, if you're in one of those higher income tax brackets, consider lowering our taxable ordinary income by using potentially municipal bonds in place of corporate bonds. It's not a one size fits all solution. We need to make sure that that's appropriate for you, for your goals, but it does open up some opportunities in that space. We want to make sure that we're considering, those no regret shifts now, whether or not we see the sunsetting, whether or not we see those income tax rate increases go through or not. We also want to make sure that we're doing, giving consideration to strategies that would be appropriate. Like I said, whether or not this does end up happening. So if we don't see tax cuts sunset, what are things we can be doing just overall to make our portfolio more tax efficient and more mindful of the income tax situations that we may face? Things like converting traditional IRA assets to Roth assets. Now, when we start to think about that, we need to be really mindful of tax thresholds that you may encounter, as well as the ripple effect of something like a Roth conversion. I'll see a lot of folks who hit that retirement time frame. Maybe they're 64, they step away from work and they say, wow, my income is a whole lot lower now. It's a great time to do a Roth conversion, which it absolutely is. You might be able to convert some Roth assets and really not feel a major difference in your tax bill. But what we need to be mindful of is the ripple effect. We need to make sure that we understand if we take supplemental income to keep us at that higher income level, are we impacting things like your Medicare premiums down the line? Remember, those have a 2-year look back, so big opportunity here. This is why whenever we're thinking about planning opportunities, strategies that we might be putting in place, we want to make sure that we're looking at it in the full context of your financial plan and your financial situation. And that's where your partnership with your advisor is crucial. Making sure that you're having these more robust conversations, not just deploying a strategy to deploy a strategy, but really understanding how this impacts, the overall picture of your portfolio. There's also an opportunity for us to think about the day-to-day transactions that we're going to do no matter what, as well as opportunities for increased efficiency within those transactions. So there are some things that we can't avoid from an income perspective. Investments will end up distributing income through dividends, capital gains. It's part of how investment performance works. But we do have the opportunity in those situations to look at how we're structuring it. For example, if you're relying on cash flow from your investments, maybe we're rebalancing proceeds and fund distributions towards cash instead of automatically reinvesting them. We're being smart in how we're handling that income so that we're not reinvesting then to just go in, have to sell out of it, and generating more taxable implications from the portfolio. Again, like I said, potentially considering shifting towards more tax efficient investments overall. We may look at opportunities like tax loss harvesting. Is there an opportunity for us to harvest losses, not only at a portfolio level, not only at a fund level, potentially even looking at inside of those funds? Do you have specific purchase dates of those shares that could be sold at a loss that could help you out from a tax situation? And then again, just looking at opportunities to generate tax-free income in the future. Again, doing things like Roth conversions now, making sure we're making those Roth contributions if you have the possibility. And those planning opportunities really exist throughout the lifetime of your portfolio. You don't have to be retirement age to take advantage of them. There may be an opportunity to do this earlier and often and really take advantage of it on a more measured basis rather than having to do it all at once. So just keep those in mind as we think about the future also. Now you've heard me mention Roth a couple of different times here. And Secure Act 2.0 also had a pretty significant impact on Roth in terms of considerations across the board. Secure Act 2.0 initially created simple and SEP Roth IRAs, which was a big deal for self-employed individuals to be able to take advantage of saving in those Roth dollar context. We also saw that now employer contributions to retirement plans can be made in Roth dollars. Now, can is the big word here. They don't have to, and not all employers have to offer this. And as you can imagine, it's complicated for employers to make this shift from everything from a administration to a payroll perspective. But we are seeing this is now a possibility, and we're seeing more and more employers deploy this. We also found out that high wage earners, so if you have over $145,000 in FICA wages in the prior year, you would have to allocate catch-up contributions to Roth, but this wouldn't start until 2026. And then we also, of course, saw the elimination of Roth plan accounts, RMDs, starting in 2024. Big opportunity here, big note here is that RMD requirement was required, which left a lot more flexibility in really using those options as part of the holistic planning that you're doing and not have as many kind of downside considerations. Now, the benefits of Roth are widespread. We have a couple different opportunities here that we want to make sure that you're well aware of to know how does this fit into my overall retirement picture or just my overall goals. We want to think about why do people like these so much? The first one is it's beneficial to you independently. Like we just talked about, we do see the potential increase in income taxes in the future, and having a Roth asset gives us tax-free withdrawals in retirement. Remember, that also benefits us for things like IRMAA considerations on your Medicare premiums. If you're going to see that premium increase, but we can use tax-free income, that's immediately beneficial to us. We're also seeing a lot of folks start to use Roth IRAs as an estate planning vehicle. It's essentially a way for you to prepay the taxes for your heirs and leave them a tax-free asset. Now, we talked earlier about the inheritance of retirement assets and the requirement for many beneficiaries to still distribute them within that 10-year period. That's still true. You would still encounter that. But remember that during that distribution phase, it is tax-free withdrawals that would be going to your beneficiaries rather than taxable. So really great opportunity to revisit your estate plan, make sure you understand who are your heirs and what impact it would have on them to inherit a pre-tax first and after-tax asset. It, of course, gives you the opportunity to lock in current tax rates. One of the few ways to do this is, of course, doing something like a Roth conversion, which guarantees that we're locking those dollars in at the current tax rates rather than potentially having to wait until you actually need to use them and paying the taxes then. And also the ability to save more on an after-tax equivalent basis. Every dollar that we have in a Roth account, that compounding, that growing on that dollar is now growing on an after-tax basis instead of a taxable basis, taxable or pre-tax basis. Now, one big opportunity with Roth planning is Roth conversions. And you've heard me mention this a couple times during our conversation today. Roth conversions are the idea of taking your pre-tax IRA assets and converting them over to Roth dollars. Now, every dollar that we convert from pre-tax to after-tax will be $1 of additional income you have in the year in which you complete the conversion. And you're going to need to be prepared to pay the taxes that are owed on them separately. You can't withhold on those taxes. Now, you have a couple of different options. Certainly the most effective way from a benefit standpoint is to be able to pay these costs out of pocket and from cash, just because it has the least ripple effect down the line. Now, one option we've seen a lot of clients take advantage of is something called threshold planning. And that's the idea that we might do a Roth conversion, but just up to the point that you would bump into the next tax bracket. So we might convert, let's say you're $20,000 away from the next tax bracket. We might convert just enough to keep you within that same tax bracket, not create an extraordinary new tax consequence. And it can be a really nice way to get the benefit of some of those Roth conversions, take it more in a piecemeal style, not have to take it all at once. Now, on the flip side, we see a lot of clients also say, I want my dollars in Roth, and they'll do a conversion, take the hit up front. But again, this is an opportunity for you to really partner with your advisor to determine what's the best course of action. Does it make sense for me to convert more up front? Does it make more sense for me to do this type of threshold planning that I've described? That's a real opportunity for you guys to partner together and determine what strategy is most appropriate for you. What we know is that Roth dollars are going to lead as tax rates increase. So let's put this all together. We know the Tax Cuts and Jobs Act may sunset if we don't see new legislation or intervention. And we know part of that will be increased income taxes for most people. So what does that tell us? Well, if we have Roth dollars, our Roth dollars are going to win if we look at an increase from where we're standing today for most people. So just keep this in mind as you're thinking about the overall context of your portfolio. Is there an opportunity to increase your Roth base? Do you have Roth dollars currently? Do you have pre-tax retirement account dollars currently? Is there an opportunity for conversions? Again, not necessarily right or wrong answers here, but real opportunities for you to engage with these conversations with your advisor to make sure you have the full scope and are taking advantage of any planning opportunities that may exist. Now, I also want to touch here on the next big piece. And like I mentioned, probably the most publicized part of the sunsetting of the Tax Cuts and Jobs Act is estate and gifting opportunities stemming from the sunsetting of this act and the sunsetting of the lifetime gift and estate exemption. I'm going to take us right back to what I mentioned earlier, which is the idea that if nothing changes, we will see that estate and gift exemption drop from 13.61 million for individuals down to about 6.8 million for individuals. This is a big deal because what we know is that for any assets that fall above our lifetime gift and estate exemption, there'll be a 40% tax imposed at your death on those assets above the exemption amount. That's a big deal. You've worked hard for these assets. You've already paid taxes on these assets. And so we want to make sure if you're going to fall above that line, that we're doing this planning early and often to ensure that you're protected if this does in fact happen. Now, for those of you who are younger, the big question is, well, will this change again? Even if we see this sunset, will we potentially see another round of changes? And the answer is potentially and probably. We see a lot of iteration on tax code over time, and the likelihood that it'll stay the same, through the rest of your life is low. So instead of focusing on chasing, again, some potential regulation change, unless you're really in that bucket, we want to look at what are your fundamental goals for your estate and your gifts over your lifetime. Do you value gifting during your life instead of at your death? Is there opportunities to go ahead and take advantage of those gifting strategies now rather than waiting until you're passing? And the reason we love to see this is it's really a double benefit. Number one, you're accomplishing the goals that you already have, whether that's either being able to see your heirs enjoy and benefit from the assets that you've saved that they're going to receive no matter what, or it's being able to give that charitable organization or institution that you so value those assets up front and seeing them being able to be put to good use during your lifetime. So just remember, the thought process on inheritance has changed a lot over recent years. We really used to look at it as something that happened only after death. We're really seeing a lot more engagement around gifting during your life as well. There's a couple of different ways to look at this. Very, very baseline is we may be able to just go ahead and complete some direct gifts to beneficiaries. If you know each of your children are going to receive assets at your passing, you feel really confident that you're not going to need them for the rest of your life, you may just decide to go ahead and gift them now, rather through the annual gift limit, which we'll talk about here in a minute, or just through outright gifts that would have gone through your estate. You may be able to, kind of the next step is to remove assets from your estate from some type of intermediary structure. Most common one here when we say intermediary structure is something like a trust. If we move assets into an irrevocable trust, we may be able to remove them from your estate, and we may be able to still give the people that you care about and need to have access to them while protecting them from an estate perspective. And the last one here, the most complex, but also the most robust, is really putting together a comprehensive wealth transfer and estate design. This is a true partnership between your financial advisor, estate planning professionals, to ensure that you have a full-scale plan and understanding of what will be taxed, what won't be taxed, how are we mitigating those taxes, what type of structures, gifts, etc. we have in place. So basically, when you think about this overall, different asset levels are going to have different needs depending on the level of gifting, estate removal that you're going to need. And that's again where that careful, cautious planning is going to be really important. Now, there's also the opportunity to go ahead and have these, conversations now. We don't have to wait until it's too late to start this gifting process. So every individual has the ability to gift up to $18,000 in annual exclusion gifts to as many people as you want. So if you have 10 grandchildren, you and your spouse can give each of those grandchildren $18,000 per year in an annual exclusion gift. $18,000 in and of itself doesn't sound like a whole lot, but when we start to put it all together, we really can have a material impact on eating away at that estate over time. You can also do things like front-loading 529s with gifts. You can do up to 5 years of gifts in any one given point in time. Just remember that counts for 5 years of gifts. So you can't do that upfront contribution and then additional 5 years of gifts. It counts. You can also pay qualified tuition and medical expenses directly to the institution on an unlimited basis. So if you don't want to go the 529 route, but you want to pay for someone's college education, you can pay for that directly to the institution without considering it a gift. It just has to go directly to the institution or the facility if it's a hospital. And then the last one's, of course, maximizing gifts to qualified charities, whether that's through taking advantage of qualified charitable distributions, if you're at RMD age, or just making those charitable contributions can be a great way to get assets out of your estate as well. So again, focus here is this doesn't have to wait. You can go ahead and start this gifting now and get those structures in place, get those best practices in place so that you have the opportunity to reduce your estate proactively instead of reactively. And that brings us right to here. I like to segment kind of the 3 consideration points that we need to be mindful of. If you're someone who has over $3 million in assets, now is the time to start an annual gifting strategy. Especially if you're on the younger end, your estate or your taxable assets can double quickly, especially when we see really strong market condition environments. And so what you'll see here on the screen is exactly how fast a $3 million net worth can double depending on different market growth levels. So we want to go ahead and start thinking about that. How are we planning? If your estate doubles, triples, how are we starting to plan already? Who are your heirs? How can we start this process now? And again, we're marrying what are your goals and what opportunities exist. We're not just taking advantage of opportunities just to do so. If you're between 6 and 13 million and you're single, or 13 and 26 million and you're married, now's the time to put in planning. We know that if this sunsets, you will be above or at the current lifetime gift and estate exemption. So now's the time to start this planning. And I mean now. We know that with all of this going down next year, estate planning attorneys are going to be busier than ever. So now is the time to have those conversations with your financial advisor to ensure that you're getting in front of the right people and getting the right planning done now instead of having to wait and scramble at the end of next year. We've seen some clients decide, an irrevocable trust might really be an appropriate solution for me no matter what, but I'm not sure I'm quite ready to fund it. I want to see what happens. So maybe they go through the process of doing that planning now. They get the documents drafted, but they don't fund it until they see more information on what might happen next year. And then if you're above $13 million in assets and you're single, or $26 million in assets and you're married, we really should already have this plan in place. You're already above the lifetime gift and estate exemption. We really should have already been thinking about how this is going to be handled upon your passing, because we're already in that danger zone of having your estate be taxable. So if you haven't done that planning, absolutely engage on it, because it's going to be a huge opportunity for you. So last items I want to wrap up with here as we think about kind of takeaways that we want to leave you with in terms of kind of where we go from here. The first one we want to think about is just thinking about RMD ages. We want to think about where you're going to fall from a required minimum distribution age perspective. Are you understanding of what year you're going to need to start those distributions? If you're falling in that window that's going to be subject to these catch-up contribution changes, have a conversation with your advisor just to make sure that you understand how that's going to impact you down the line. If you're a parent or a grandparent and you haven't already, if you have grandchildren, children, good consideration to go ahead and start those 529s up if that's something that's going to be important to you down the line. We know that 529s have a tremendous impact on the ability to cover education savings. And we also know there's some exciting new regulations that we may be able to take advantage of when we think about the benefits down the line. Remember, we now have the ability to roll over part of 529s over to Roth dollars, which gives us a lot more flexibility. We want to start to think about, in terms of the tax sunset, will your estate be subject to the lifetime gift and estate exemption now, or in the case of sunsetting? We want to think about opportunities for Roth conversions within the portfolio. And we want to think about, if you're on the younger side, are you a good candidate for something like a backdoor Roth contribution or a mega backdoor Roth contribution? Are you considering the conversion of pre-tax to post-tax assets as well? And then on the gifting side, are you taking full advantage of gifting opportunities that exist for you? Are you bunching gifts where you can? Are you using qualified charitable distributions if you're of that age? What I'd really encourage you to do is focus on creating a true gifting strategy that you're going to follow on an annual basis. This can certainly factor in to the protection of your estate from that lifetime gift and estate exemption reduction, but it can also just be hugely beneficial to meet your long-term legacy goals and needs as well. So really exciting opportunities here, lots of changes on the horizon for us, but really want to make sure that you have those tools, resources, and knowledge to be able to have those conversations with your advisor and start to get some of these strategies in place if they're appropriate for you. So I want to thank you all for the time. I know I've done a whole lot of talking. I want to turn it back over to Madeline to host some Q&A.
So Tom, I think you have some questions for us.
I was definitely going to jump in with a couple, but I wanted to make sure that everybody knew they could answer or ask questions as well. I think the Q&A functionality should work within Zoom. So if anybody has any questions, please feel free to write your questions in. Allison, this is something I have an opinion on, but I just wanted to ask. I know you said clients shouldn't necessarily chase changes in regulation with their estate plan, but how frequently should people review that estate plan?
Yeah, it's a great question. I'd say industry-wise, the general rule of thumb is every 5 years, but I'm going to give a huge asterisk there and say unless anything changes, death, divorce, other family situations, if you have a change in a relationship with one of your key beneficiaries, all really important times to review those estate plans, because what we don't want to end up happening is you pass away and you have some type of unintended consequence coming out of your estate plan. So it's really important, if you haven't reviewed them in a while, there's not necessarily a right time. It's basically, as soon as we realize that a change may need to be made, if you haven't looked at it in a couple of years, it's a good time to check back in on it. Love to hear your perspective as well, Tom.
Perfect. Well, I know 5 years is definitely a rule of thumb, but I know a lot more attorneys are actually offering almost like a subscription plan where you have the ability to have an annual review with them, and if any changes need to be made, you can do that. And so, depending on what the arrangement is with the attorney and really what the cost is, as long as it's not prohibitive, if you could do it more frequently, I think that would be great. We do have a couple of questions from clients or attendees on the call, so I do want to make sure we get to those. Maddie, if it's all right with you,
Yeah.
I'll jump into one of those. So one participant asked, just is there anything new as it relates to step up in cost basis?
So maybe if I can get a little more clarification around that. Are we talking about basis in terms of how it would apply to like inherited property in that situation?
I think so. It doesn't say in the question, but I think if we look at it from that perspective, that'd be great.
That's always somewhat on the table. I think we don't have any concrete changes that are being, promoted right now, but I think that'll become more and more enlightened as we see how this is all going to play out in the future. So something to watch. I'd say it's always something that's coming up, not necessarily anything out of this specific piece that we're looking at, but happy to clarify there as well.
Okay, thank you. And if the person who asked that question, if that doesn't address your question, please give additional context and be happy to dive back into it. Another question, this was more just a request to reiterate the RMD rules as it relates to inherited accounts. If you could just kind of repeat the 10 years younger, if it's left to you versus, the 10-year distribution requirement versus being able to stretch.
Okay, so it's complicated, but I'll walk back through it. I know there's a lot of moving pieces with this. So when we think about the 10-year rule, remember that's going to apply to our non-eligible designated beneficiaries. So if you're an eligible designated beneficiary, we're going to put you to the side. And if you're a non-designated beneficiary, we're going to put you to the side as well. So it's kind of our middle column, if you will. For that middle column, and again, most common is our adult children who fall into this bucket. If the original account owner had started required minimum distributions, the inheritor, so the primary beneficiary, will need to continue distributions and get the assets out within that 10-year window. If the original owner had not started required minimum distributions, the inheritor or the primary beneficiary only has to get them out within that 10-year window. That's the key there is RMD start, distributions have to continue, and 10-year window, RMDs hadn't started, just the 10-year window.
Allison, I'll come over the top on that too, because I know this question's come up a little bit. I mentioned this to some clients. And so when you think about the scenario again, let's say your elder parent passed away, they were 75, 80 years old, they were taking minimum distributions. The minimum distribution calculation that you'll have to take each year is based still on your life expectancy as the beneficiary, kind of the old rules. So there's almost this legacy to the stretch. Now, whether or not you're going to take that stretch or smaller amount, in most instances for years, let's say 1 through 9, and take everything out in 10, that's really specific to your circumstances. We have a number of clients who are still working, probably winding down their career over the next 2 or 3 years. So it makes a lot of sense to take those minimum distributions in years, 2025, 2026, and 2027, and then backload that in the latter part of the period to get out in 10 years. I want to come back to the stepped up basis point for a second too. There's this thing called the Green Book, which has been in the press at various times, usually around election time, where there's been talk about whether it's doing away with the step up in basis, doing away with some trust tools like GRATS, grant to retain annuity trust. Again, there's been nothing really in the domain today that's speaking to those things. I would venture to guess once we have a result in November, that might pick up in earnest. And clearly, I would think you're more likely to see the loss of the step in basis, but I still think that probably that's low with continued Democrat administration versus Trump's return to office. So sorry, Allison, I'll turn it back to you as the subject matter expert. I know we got a couple other questions that have come in since then.
No, that's great. And I'll just tack on one thing to your comments on inherited IRAs, because I mentioned it earlier, but I just want to clarify. If you haven't been taking them, like let's go back to our example. Let's say you inherit an IRA in 2021. You didn't take your distributions when you should have from 21 to 24. You're fine on the distributions, but your 10-year window is still from 21. So just remember, while you're getting this waiver on the penalty on any distributions you were supposed to take, your clock is still ticking on that 10-year period. So just be mindful of that as well.
And just a follow-up question on that, Allison, if that's okay.
Yeah.
So the 10-year window exists, and I think once we start getting into the details here, it's probably going to get pretty specific to the client and their tax situation, their income levels, and things like that. But in theory, if you had a younger adult child and their income more than likely will increase over time, would it make sense for them to potentially accelerate some of those distributions to start to empty out that inherited IRA before any of these tax cuts potentially go away?
Oh, I'm so glad you asked that. It's something that we've been doing a ton of research on here at Vanguard because it's a really interesting question. As Madeline mentioned at the top of the conversation, I sat in the advisor seat for some time, and when this original legislation went through, there was a lot of questions on what do we do? Do we take it up front? Do we take it at the end? Do we spread it out? Do we take just the RMDs? We've done some research here at Vanguard, and we've actually found that in many cases, accelerating some of those distributions and not waiting until year 10 actually may be more beneficial from a tax perspective. So that's, again, a real opportunity. If you're in this situation, as you're hearing us all describe, it's complicated. So if you get in that situation, really working with your financial advisor to determine what's best for me and not necessarily just going off of what you're hearing your friend, your neighbor, your relative doing is going to be critically important on how you inherit this. Because, what I'd say, Tom, is, you may very well benefit from accelerating some of those distributions.
I'm going to throw one other quick point out there too, which we always have with an intelligent group of clients, folks trying to, if not game the system, find the loopholes there. So I've had the question asked all the time, or hey, can I put my 3-year-old grandchild or great grandchild on as the beneficiary so I get that stretch provision till 21? And in my understanding, and you correct me if I'm wrong, is it's only if your children are under 21 where you have the ability to stretch or wait till 21 before the 10-year clock starts. So not so fast, so to speak. If we put our 5-year-old grandchild on there, they're going to be still required to take the 10-year distribution because they're not a qualified or designated beneficiary.
Right. Yeah, the IRS likes to think through. They're trying to make sure that as much as we're thinking through the loopholes, they're trying to catch them as well to make sure that they're getting their tax revenue.
One other ask, Allison, if you don't mind, are there some good resources that clients might be able to tap into? I know we use some stuff that Schwab has out there. We'll send our own content from time to time, but Vanguard being the juggernaut that it is there a place specifically on the Vanguard site or even an external resource that you recommend for clients to just be poking around on, just kind of get familiar with some of the various tools and techniques that might be out there?
Yeah, absolutely. One thing that I can certainly share with the team here, and then you guys can certainly pass on to clients as well. we actually have formalized some of that research that I just mentioned around distribution strategies, which I think is a great read, just so you can have that conversation, that deeper understanding of not only what's the lay of the land, but how can I be really strategic about this? I think that opens the door to a deeper conversation around, who are my beneficiaries? How will they inherit my assets? And is there an opportunity to be more strategic in the designations that I've made to really mirror what I want reflected in my estate plan? So I will certainly share that with the three of you, and would encourage, feel free to share that as well. Great resource. And we have, through Vanguard, we have a lot of different resources across distributions and kind of continuously coming out on this topic. So that's where, we really value the partnership with, of course, this team here, and we'll continue to send the resources that we generate exactly your way, so you can share them out as well.
Thanks so much. Maddie, do you want to take us home? And then I'll spend a couple minutes on, just a quick lay of the land, market update, and the like for those interested here this Thursday afternoon.
Yeah, absolutely. This is a topic that we get a lot of questions about. And if you have more specific questions and how they relate to your specific situation, as Allison touched on before, a lot of this is situationally dependent. So we absolutely want to hear from you, especially when it comes to the personalized gifting strategies. Those are conversations that we always try to flush out with our clients. So please let us know. And Jeff, I will let you take us home here with the market update.
Yeah, look, thanks, folks. And I'll be very sensitive to the time. Our quarterly market updates, which run oftentimes 75 minutes or so, I know we'll look to close far quicker than that. So again, if I were to think about the kind of four pillars over the next, let's call it 60 days, you've got Powell, who will speak tomorrow at Jackson Hole, and again, I think he's been pretty clearly a dove for the better part of the last year or so, and so we fully expect him to really kind of lay the path forward for the first cut to start in September, and possibly even introduce further easing in the November and December meetings. They have the month of October off. Next, unless it be payrolls, right? And I think that just kind of ties to Powell's conversation, right? Again, the clear shift has been away from inflation on the basis of the dual mandate, right? That was obviously the focus since 2021. So we spent 3 years or so, really just laser-like focused on getting inflation back closer to their 2% target. But as we've seen a little bit of slackening in labor markets, the idea is to try to pull off the 1994 soft landing scenario. And again, that's going to be critically important to just kind of keep the unemployment rate around this 4.3% territory. So we'll see the August jobs report the Friday after Labor Day. So be on the lookout. That's about 2 weeks out from tomorrow. Then profits, right? So again, we're sticking with threes: Powell, payroll, profits, and we'll round out the last one, which I'm sure you can put 2 and 2 together at this point. Profits, we just wrapped up third quarter earnings season. This really kind of was the last week. We heard from Target and Ross Stores and a couple of retailers. And it's hard to say anything other than the third quarter was a solid one. Earnings came in about 10.3% on a year-over-year basis. Again, kind of a little better than the estimates as we started earnings season. 80+% of companies beat on their bottom line. On revenues, the beats were only about 60%, so a little bit less, but still, again, a positive story. As we get into the third quarter earnings, which we'll hear in October, the idea is the hurdle is probably a little bit higher, and why we've seen some caution from the C-suite as they've reported their earnings numbers here is kind of we go through the same dance where they'll lower estimates, analysts will, between now and October, so that the bar is that much easier to hurdle over. But again, with the stock market today trading at 20, 21 times, if earnings can grow at these double-digit pace, we feel somewhat comfortable with where prices are, right? If earnings ultimately can't deliver because the economy is truly slowing down, there's probably some question as to whether or not we can maintain these 55, 500, 5,600 levels on the S&P. The last thing is politics, right? We're now basically 75 days out from November 5th. Hopefully we'll have an idea of who the next president is on that Wednesday, versus needing to do something that resembles what took place in, to some extent, 2020, but definitely going back to 2000. And of course, need to get involved because there is such a tight range here in terms of where the polling's showing. My sense is that again, while there'll be a reaction to what happens, and so some people will be offended by the comments, others hopefully will not. But the point is, the market will go on, right? We'll wake up the next day, and economies like ours will continue to be resilient. Businesses will continue to sell their products and services. So while you could expect a little bit of volatility around the event itself, I do think that as we're out 60, 90 days beyond the election, we're going to continue to be dealing with the momentum or progress that's being made on the part of the economy. And in the last week and a half or so, 2 weeks post the little panic we saw at the start of the month, have shown that again we continue to be pretty resilient. So without taking up too much time, we'll end here a little bit before 2 o'clock. That's East Coast time. I want to wish everyone a happy Labor Day holiday. It's kind of hard to imagine the summer is behind us, but we're looking forward to winding down Q3 in September and in a perhaps exciting Q4 ahead. Thanks so much for the time.